I'd like you to imagine this with me. This is Jimmy, and this is Brian. Both Jimmy and Brian work for the same tech firm and at the same department. Jimmy is a data analyst who earns $70,000 per year. On the other hand, Brian is a bit higher up in the corporate ladder and earns $140,000 per year as an operations manager. A few months down the line, the tech firm made an announcement. Due to the lower profits that year, they decided to shut down the department where Jimmy and Brian were, leaving the two of them out of jobs. Eventually, after 4 months, they both found new jobs and restarted their normal income cycles again. But here's the thing. Throughout their unemployment phase, Jimmy managed to get by and cover his monthly expenses as normal without being heavily affected. And even though he reduced his leisure activities during this phase, he still had the ability to socialize every now and again with his friends and family. However, things were not that great for Brian. He actually was in so much trouble from suddenly losing his income that he had to declare bankruptcy only 2 months after unemployment. So what's the reason behind that? It doesn't really make any sense. Brian used to make double what Jimmy did, and despite that, he ended up bankrupt so quickly after losing his income. You see, the sad story here is that Brian isn't the only one in this dilemma. In fact, there are millions of Brians in the US and the UK who are literally living on the edge of financial ruin. Now, going back to Jimmy's and Brian's story, there is a very good reason why these two had such different experiences when their income stopped. And that reason is down to this one key financial metric. And that metric is known as net worth. So what is net worth? Well, aside from the fact that it's that thing that we tend to Google when we want to know how much money a particular celebrity has, net worth, in very simple terms, is the value of everything that you own minus the value of everything that you owe. Or in fancier terms, your assets minus your liabilities. You can think of your net worth as your own personal balance sheet. You see, in the business world, one of the key documents that dictates the health of a company is its balance sheet. And oftentimes, a dodgy-looking balance sheet will raise quite a lot of red flags and scare away any investors. And it's completely understandable, given that the company can be basically wiped out overnight by its debt at any moment. Unfortunately, the same thing applies to people as well. And often the presence of major imbalances between assets and liabilities puts that person at a very high risk of financial destruction at any moment in time. And here's the interesting thing about net worth. Net worth is not directly related to your level of income. You can very easily be a high earner and have terrible net worth if you make the wrong choices, like Brian. And equally, you can still have a very nice and healthy net worth even if you are on a lower salary. However, that doesn't mean that you shouldn't be seeking to increase your income, because having a higher income gives you a much better opportunity to increase your net worth if you use the additional cash you get from your extra income wisely. Now, let's have a look at what counts towards your assets. These are usually things like your house, your bank account balance, savings, retirement or pension accounts, investment real estate, and many other holdings. On the other hand, your liabilities are things like your credit card balance, your car loans, mortgage, student loans, and any other types of debt. And for your own benefit, here is a more detailed list of assets and liabilities that you can pause the video and read through. Now, don't worry if that list looks a bit extensive and confusing, because I will go through it in a separate video after this one. And in that video, I will build and go through an Excel spreadsheet tool that will help you calculate your own net worth. So be sure to subscribe and hit the bell button so you can stay notified when the video comes out. Now let's go back to the example of Jimmy and Brian. This is Jimmy's income versus expenses table. As mentioned before, Jimmy has an annual salary of $70,000, which after taxes equates to roughly $4,000 per month of net income. Jimmy pays $1,600 per month for rent, $250 for utilities, $400 towards student debt, $200 towards food and groceries, and $250 for fuel and car insurance. Jimmy also reserves $500 for leisure activities, things like gym membership, subscriptions, and going out with friends. This leaves Jimmy with $800 remaining every month that go towards growing his emergency fund savings and investing in a low-cost index fund. This means that every month, Jimmy's assets slowly grow while his liabilities gradually reduce as he continues to pay off his student debt. Now let's look at Brian's table. As we know, Brian has an annual salary of $140,000, which after taxes equates to roughly $8,000 per month in net income. Brian pays $3,500 towards his mortgage every month, $900 in utility bills due to having a bigger house, $1,300 in car payments, $400 towards student debt, $350 for food and groceries, and $450 for fuel and car insurance, leaving him with $1,100 remaining every month, which tends to go towards eating out in fancy restaurants 3 or 4 times a week, regularly buying brand new furniture to complement the look of the house, and perhaps the newest iPhone, even if the current one works perfectly fine. Anything extra tends to go on the credit card. In essence, this means that Brian's asset column doesn't really receive much at the end of the month. In fact, it actually decreases from month to month, given that it's mostly filled with things that go down in value over time. Meanwhile, the liability column keeps compounding every single month. Now, Brian isn't really concerned about this, and he's very confident that his high salary covers all of these things. And it does. However, what Brian doesn't know is that his salary represents a single thin leg that's just strong enough to hold a table, on top of which lies the stability of Brian's life. And should the day come when the single leg breaks, so will Brian's financial life. Brian was so fixated on his income statement that he completely forgot about his balance sheet, leaving him completely bankrupt almost immediately after losing his job. So the one lesson to learn from Brian's story is that we need to care about our own personal balance sheet. And the only way to improve it is by knowing where we stand today. Okay, let's say that you took action and decided to calculate your net worth, which is definitely great news. Now, what do you do with this information? Well, there are 2 ways you can look at your current net worth. The first one is in money language, while the second is in time language. The money method simply means assessing your current net worth amount against a personal figure that you'd like to achieve in the future. For example, if your current net worth is $30,000 and you wish to be at $50,000 1 year later, then you now know that you need to increase your net worth by $20,000 in 12 months' time. Now, the second way to look at your current net worth is in time language, and this is my personal favorite. And to explain this method, let's take the same example from before. Let's say that you found your current net worth to be $30,000, and let's assume that your necessary monthly expenses like rent, bills, and debt repayments total to $2,500 per month. Now we can apply the following division, which takes your current net worth value divided by your necessary monthly expenses. In our case, that would be $30,000 divided by $2,500, which equates to 12. This is the number of months you'll be able to survive without an income and without having to take on any debt. This is a good way to look at your net worth, as it gives you a clear indicator of where you're standing from a financial health perspective. And of course, the number of months can be increased by either increasing your net worth or reducing your monthly costs. However, I'd personally encourage you to aim to increase your net worth rather than reduce your monthly expenses, as there's only so much you can cut down from a monthly cost perspective. I hope you found the information in this video helpful and that you now have a better understanding why knowing about your net worth is really important. And in the next video, we will take a deeper dive to understand how you can practically calculate your net worth and track its progress over time. So please don't forget to subscribe to the channel so that you don't miss out on the video when it comes out. But for now, the key takeaway message is it doesn't matter how much you earn as much as what you keep and what you do with what you keep. See you later.